Well, welcome everybody to this ESG seminar from FMD. Thanks for joining us today. I think we've got about 40 people online at the moment, so we might get started. I'm really excited to present this topic today. My name's Lee Wapling. If you haven't met me before, I'm the CEO of FMD Financial. I think today's topic's a really interesting one. It's also really complex. There's a lot of interest from our clients about the topic, but what does it really mean? ESG investing, well, the ESG is environmental, social, and governance. But what does that mean? What I hope you come away with from today's seminar is a little bit of information about what that means in practice for investing, some understanding of how those factors might be important to you. Some you might need to think, if you're interested in this space, start to prioritize what's most important to you. Hopefully you get a sense of how FMD is bringing these ESG factors into the portfolios that we manage on your behalf. And perhaps you'll feel better prepared for a conversation with your advisor if that's something that you wish to raise in the future. So we're joined today by two really special panelists. I'm really excited. We've got some real experts on the call or on the conference today. And I think if I'm sharing correctly now, we've firstly got Liz Harrison, who's a fixed interest strategist ESG from Janus Henderson. Liz has been on the team since 2020, and prior to joining Janus Henderson, Liz was a fixed income product specialist at Scala Partners in Melbourne. She also has experience in Australia and the UK working at Lehman Brothers, the Australian Wheat Board and Orica. Also joining us today is Dug Higgins. Dug is the Head of Responsible Investing and Sustainability at Zenith Investment Partners, Zenith FMD's primary investment consultant. Having joined Zenith in 2009, Dug has accountability for the management of key services across Zenith's research, consulting and corporate divisions, including in responsible investment principles and the group's corporate social responsibility programs. He's also the chair of Zenith's Responsible Investment Committee. Dug has 21 years experience in the fund research industry, spanning a wide range of asset classes and investment structures, including time as an associate director at Property Investment Research. Liz, Dug, thank you both very much for joining us today.
Thanks, Lee.
Okay, so just a little bit of housekeeping, if I may, for our audience. We'll hopefully allow a bit of time for questions at the end. So in your box, if you can see the Q&A little icon there, just click on that and type in any of your questions, and I'll do my best to get to those and invite the panelists to answer those. There'll also be a quick survey at the end of this, so we just appreciate you giving us some feedback on how valuable you found today. Very difficult in the moment to provide technical support, but if you do find you drop out, the best advice I can give you at the moment is to refresh your browser and reconnect. Hopefully everyone's internet runs smoothly today. Okay. Of course, a little disclaimer from us, just reminding you that what we're talking about today is general advice, and we haven't considered anyone's personal circumstances. So please talk to your FMD advisor before making any decisions. All right. Now, let's get straight into this. Can I start with you, Dug? A one-on-one. What is ESG?
Yeah, look, it's a thorny question, as you alluded to before, Lee, and I think the simplest way to put it, it kind of depends on who you talk to, because for some people, it's an ethical way of viewing things, wanting their values to be reflected in how they invest. Maybe it's not wanting to profit from gaming or fossil fuels, but for other people, maybe it's about wanting investments to be in companies or sectors that are trying to be greener or develop cleaner fuels or address environmental or social issues. So there's really no real right or wrong answer. I think it's about understanding what a person's viewpoint is and trying to accommodate those views if they are thinking about preferences over and above just simply looking at risk and return. And so for us at Zenith, we use the term responsible investing as an umbrella term, which encompasses three different buckets around ethical investing, sustainability investing, and ESG incorporation. And we would argue that ESG in its purest sense is just a way of including those ES and G issues that you spoke to, environmental, social and governance, in analysis in as a way to better identify risks and opportunities. But it is important to note that ESG in and of itself, it doesn't have a green or moral filter. And I think this is one of these things where it can get a little bit confusing sometimes for people and the rest of the industry, is about, well, are they talking about ESG as sustainability or as an ethical view or as something else? And so, as we sort of touched on before, we would say, look, ethical investing is really about prioritising, screening out negative companies or industries, whereas sustainability, on the other hand, is more about advancing causes. And so in the middle of that, ESG, each of these three buckets, ethical, sustainable investment, they can overlap, which is why some ESG strategies can morph down into the ethical side, or they could morph through into the sustainable side, but they are separate buckets and separate approaches, which might be standalone or they might be combined. So that's how we view it.
Thanks, Doug. Sorry, the unmute button eluded me there for a moment. So it's really broad in how it can be looked at. So with such a wide range of approaches, how does an individual investor decide what's right and what fits their preferences?
Yeah, exactly. As we say, it's like it's a broad church. There's no one single road to responsible investing. And so I think, if a client is looking at this sort of thing, I think, what's good or green is very much in the eye of the beholder. And so, we don't think there's any one way to do it. So I think as an individual investor, you need to understand what matters to you. And you have to work out what preferences, if any, you want your investing to accommodate over just the risk and return. Are there ethical issues that you want to avoid? Are there sustainability preferences that you'd like to support? Or do you just want your managers to be actively thinking about the various risks and opportunities associated with the challenges around ESG and act accordingly? Because I think it's important to understand that the vast majority of fund managers that we see out there do think about ESG in some way, shape or form when they look at their investments, but that shouldn't necessarily be confused with them overtly trying to target a fund to be either ethical or sustainable. And it's also important to understand that not all asset classes can really handle all forms of investing responsibly. So it's good to understand, I think, when you're looking at a fund or an opportunity for someone, what does a robust, authentic outcome look like in this? Because we would say that, look, not everything that is good is green, and not everything that is green is sustainable. And so understanding what's practical and achievable in your investments is really important. So, for the individual client, getting a feeling of, what's important to them. I mean, is it maybe green buildings or climate solutions? Is it a risk view? Is it an avoid or advanced view? These are the things that you need to kind of drill down into before you can then start to work, well, what is going to be a good outcome in trying to facilitate that?
Thanks, Doug. Thanks for that. So Liz, I might bring you into the conversation now. The Janus Henderson fixed interest funds form an important part of the many FMD client portfolios. So can you perhaps bring that practical fund manager perspective into how ESG is integrated into the portfolios that you manage?
Yeah, sure. Thanks, Lee. So from our perspective, rather than having an ethical or sustainable fund as such, we just integrate ESG into our full investment process. And this is the same process that is applied across all of our funds and mandates. So we're referring to then the Tactical Income Fund, which is our flagship fund, that has the same processes as every other fund and mandate that we manage. How we integrate it is done in a number of ways. So at a high level, this includes undertaking risk mitigation, through applying negative screens on certain controversial sectors, as well as our gated approach, which prevents single issuers that have what we would call material ESG risks from being included onto our company approval list for purchase in portfolios. We also undertake, which is the green part there on that slide, undertake positive screening of our investable universe. And this includes identifying companies that we deem are best in class on a number of ESG metrics, also undertaking direct company engagement with issuers, and through supporting the positive impact debt market. So this includes, both buying sustainable label bonds, but also just providing feedback to the banks and intermediaries about what our preferences are for potential new issuance of sustainable debt. I think you're on mute there, Lee.
I've done it again. It's a really broad approach across your entire portfolio is really what you're saying is your approach to integrating that ESG and positive impact into your portfolios. So, Doug, as Zenith's our primary investment consultant, that role is to bring a number of ideas to us in terms of from asset allocation through to manager selection, in terms of how we implement portfolios for our clients. Can you talk about what Zenith's journey into ESG considerations look like and how that flows into what FMD does?
Yeah, absolutely. So I think, as we've sort of alluded to before, it's really important to understand that not everybody has the same objectives when looking at responsible investing. And us as researchers, because we look at essentially all types of investments all around the world, every asset class, every strategy, we think that trying to adopt a single way of looking at funds and what they're doing in this space kind of doesn't really work. We think that it's necessary to essentially adopt a fit-for-purpose approach. Understand what a fund is trying to do as it pertains to responsible investing, and then see if it's being done in a way that's justifiable and authentic with good outcomes. Because, what does it look like in equities? What does it look like in fixed income? We want to understand, what does a good approach look like? When does it make sense? What does it mean for investors? And our journey has taught us that, this is a real maze, because nobody agrees on what good or green is. Nobody agrees on how to measure it. And so, ultimately we think that there's no substitute for hands-on research with fund managers to try and cut through all that noise and understand what they're doing, so that our clients like FMD can work with all the viewers on the call today, to get those best outcomes. We feel that, sometimes you've really got to almost hold the manager's toes to the fire to, really get down into, well, what are you actually doing? Is the way that you're looking at a particular company, meeting up with what you're actually telling the world on the other hand in how you look at it? And so I think it's important to note that we're not trying to, work out who's got the deepest green fund out there, because there's no real way to measure that. We just want to understand is, well, what is that particular fund trying to do? And you've got to look at it at a fund level, because obviously managers can have a lot of different funds and a lot of different approaches. And so, it is what's sort of on the paper ringing true with what they're actually telling you face to face. And so, us being able to try and get a read on that and then translate that through to our clients so that they can understand where does that best fit between a particular product and a particular client's preferences start to come together.
Thanks, Doug. So let's get deep into a fund then, Liz. Can I ask you, you talked before about your negative screening. Is it as straightforward as just screening out certain sectors, or can you talk us through some examples of how you approach that?
Yeah, sure. So, as I mentioned, across all of our funds, we have what we call sector negative screens. On this currently includes tobacco manufacturing, controversial weapons, and adult entertainment. So this means that issuers that participate in those industries are automatically screened out of our investable universe, so we can't invest in them. But it's not really as straightforward as that. It does get a lot more nuance when we dig further into other product involvement within a company. So, a company may not be involved in the three that I mentioned, but they may have exposure to other sectors that we would deem as, controversial, and we need to take this into consideration. So what I mean there is they might participate in alcohol, gambling, fossil fuels, fur, shale gas, palm oil, etc. So during our single issuer assessment, which was on that previous slide, we look at all this. There are obvious ones that we don't buy, like, Origin Energy and AGL, just because of their high exposure to fossil fuels, and Tabcorp and Crown we don't either, because of their gambling exposure. But there are companies that have diluted exposure to these other controversial sectors, and this requires a lot more in-depth, analysis. I'll give you some examples. We negative screen for tobacco manufacturing, but this doesn't preclude us investing in Coles and Woolworths that they sell tobacco. So what we're looking for here is what percentage of revenue this makes up to decide whether we think that is an ESG risk for that issuer. Apple is another example. So they don't operate gambling apps, but they facilitate the use of gambling apps, which we need to take into consideration. Real estate investment trusts, they don't actually operate pubs themselves. They're a landlord, but they are a landlord to businesses that often operate alcohol and gambling venues, for example. So armed with all this information, it's up to us then to make a qualitative assessment on if the involvement in these controversial sectors are what we would call material ESG risks to that company, and are likely to negatively affect, the financial profile of the company, potentially lead to, a ratings downgrade, and, obviously affect the price of their bonds as well. So this is all part of the company by company screening process that we go through. ESG risks are equally as important as business risk, financial risk, and management risk, and we assess all of those equally, alongside each other. If we do find that a company has material ESG risks and we don't believe that there's anything they can do to mitigate that risk, then we automatically negatively screen them out as well, so they're not added onto our approved list. So I'll take you through some live examples. I mentioned earlier that we don't participate in concentrated gambling names such as Tabcorp and Crown. But, as I said, there's many others that we haven't approved for ESG reasons, which are, not as straightforward. So one of them, maybe a year ago or so, was Ale. They're a listed real estate investment trust and owner of 86 pubs around Australia. This one, raised a lot of debate amongst the team. We discussed the rise in problem gambling and the potential for, change of responsible gaming regulation. So while we don't actually have an explicit screen on alcohol and gambling, we're just aware of these issues. And also alcohol as well, society's changing attitude around, responsible alcohol consumption. So we married this up, the ESG concerns that we had with other non-ESG factors at the time, and then we decided that we wouldn't approve this credit. And in a completely different industry, we also not only do we not approve issuers, but ones that we may have had on our approved list, we can suspend them because we're concerned about some ESG risks. And one recent one was Suncorp Insurance. We've been particularly concerned about the industry in which they operate in, for a number of years, and we've been engaging directly with the company to try and understand how they can possibly mitigate the risk. The effect that, climate change is having on, both the severity and the frequency of, natural disasters, floods, bushfires, etc., really makes it very difficult to invest in the insurance sector. On engaging with them, we ascertained that the only tool that they really had at their disposal was to put up their premiums and perhaps do some recapitalising as well. But there's nothing that they can actually do to mitigate the risk of changing weather patterns. So for this reason, they're another example of one that we haven't approved. Well, we did have approved, but we've since suspended them on our approved list due to ESG risks.
Thanks, Lisa. What I'm hearing from you here is that this isn't Liz Harrison's moral overlay over ALE or Suncorp. It's looking at those entities and saying, well, what are the social or environmental risks that could have an impact on the value of those bonds that you might purchase, and saying, well, we don't think that risk is manageable enough, so we don't wish to take that risk and not hold that bond.
Yeah, absolutely. We're just trying to avoid any pitfalls, if you like, of companies that we don't consider are sustainable. There might be stranded asset risk, for example, as well. So ones that we don't think have a viable future. Yeah. Obviously, we don't want them in our portfolios.
Yeah, great. So that's probably the negative side of the equation. Is it worth maybe exploring for a moment the I guess that using ESG metrics, see which issuers and bonds are best in class, and talk us through what you're doing in that regard from a perhaps a positive impact perspective?
Yeah, sure. I mean, as I mentioned earlier, it is a qualitative assessment when we're deciding whether to include an issuer. But to accompany this, we have built out an analytical tool which brings in ESG metrics from third-party providers, so Sustainalytics, MSCI, ISS. I admit there is a lot of data gaps, so it's not foolproof, but where possible, this tool can pick up an individual company's carbon intensity, their greenhouse gas emissions, if they've had any ESG controversies, what their gender diversity looks like in senior management, any waste management initiatives they've got in place, what their employee satisfaction statistics are, governance metrics, etc. And this in itself, can help paint a picture of a company's ESG credentials, but more importantly, probably, it assists us with our engagement questions. So when we talk to these companies, it really steers the questioning on, the company's decarbonisation commitments, how their carbon emissions might compare to, their competitors or their peers, the tracking of interim carbon reduction targets, the transparency of their reporting, circular economy projects they've got in place, as I said, gender targets for senior managements. And just on that slide there, you can see some of the questions that evolved from having this information at our disposal. I'll give you some examples, actually. We had, just in the last, couple of months or few months, we've talked to Woolworths about their waste and water reduction programs, their switch to renewable energy sources. We've asked them about improvements that they might make on stocking, more nutritious foods. Coles, we had a really in-depth meeting with them to discuss their net zero carbon targets, what they're doing as far as, recycling and reduction of plastic packaging. We had quite a robust discussion on the removal of high-emitting refrigerants and moving across to natural refrigerants to reduce their greenhouse gas emissions, and charitable initiatives they have in place. Another important one was Wesfarmers. We also spoke to Coles and Woolworths on this as well, just to understand what they're doing to combat, modern slavery risks within their supply chain. And Toyota, the autos, Toyota, VW, we've spoken to both of those in the last couple of months just to get a really good understanding of, what their electric vehicle rollout looks like as well. So it really does help shape our engagement meetings.
Great. Thanks, Liz. So moving on from that then, what about sustainable debt? Can you give us some colour about what types of bonds in the world are more positive than that in terms of, what Janus Henderson's doing in that space?
Yeah, sure. So, we're a big advocate for these bonds. We hold over $1 billion of sustainable bonds and term deposits in our mainstream fixed income funds and mandates. We've participated in all the main types of structures that are available in Australia. I just want to also mention, first of all, that we, as I mentioned, we're not an ESG label fund. So we only buy these bonds where, one, it makes sense from a return perspective, where the issuer itself meets what we would call our stable and sustainable quality test, where we feel like the structure is actually doing good. So trying to prevent greenwashing here. So not just, we may see an issuer that is just trying to use old, green assets and they're recycling them for the purpose of a green bond, or companies that, they would be doing this anyway. It's business as usual for the company, but then they're dressing it up as a green initiative or a green asset. Or in the case of sustainability-linked bonds, where we're making sure that, their targets are ambitious enough. So just sort of put that on the table first. But to your question about the types of sustainable bonds that are available in the market, I mean, these include the traditional green bonds, in which capital is used to fund environmental projects. These are called use of proceeds bonds. The banks, the property groups, universities, etc., are all issuing green bonds. The semi-governments, they're big issuers of sustainable bonds, and they issue these off their sustainable bond framework. This is where they identify a pool of environmental and or social assets which have been independently authorised, and then they issue bonds to fund these assets. So if you think of those assets, they include, things like electric rail systems, water management plans, solar rebates to households, affordable housing projects, disability support packages, etc. So they're on the asset side, and then they'll issue a green bond on the back of it. So the New South Wales government, Queensland, Victoria, they've all issued off their sustainability bond framework in the last few months. There's also the new kid in town, which is the sustainability linked bonds. This is where the coupon amount is linked to the achievement of specific environmental targets. So if the target is not met at the pre-agreed timeframe, then the issuer is penalised, and the in the form of its coupon stepping up. These are quite new to Australia. They've been offshore for a long time in Europe particularly. But the likes of Woolworths and Wesfarmers have all brought these to market here in Australia, which we've participated in. And the other one, which we really like, are social bonds. I mean, social bonds are still quite a small percentage of the market share of sustainable debt here in Australia, but that is growing. There's a couple of really good ones that we've invested in. One of them was an Asian development bank, in which capital here was directed to projects that promote gender equality and the empowerment of women in third world countries. Another good one was the Australian government-backed issued National Housing Finance Investment Corp. Here, the proceeds were used to help low-income and vulnerable Australians afford affordable housing. So some good social bonds coming to market.
Great. Thanks, Liz. Thanks. Okay. So, Doug, we've talked about positive screening, negative screening. We've talked about some, social bonds, and we've talked about the complexity of assessing what ESG means for different people, or responsible investing means for different people. So, do you think you need to give up returns when investing in an ESG fund?
Yes, it's a perennial question, obviously, in the industry. And my simple answer is that it's probably actually not the right question, because we would, like an automatic answer to say, well, does ESG outperform? It should naturally be, well, with what sort of ESG fund? Because as we've been talking about, responsible investing is not a universal concept, and investment strategies aren't a universal concept either. So we would argue, firstly, that, well, okay, you've got to understand that the performance of responsible investments doesn't necessarily have a lot to do with the performance of responsible companies. And the reason I highlight that is to say, well, if you're a fund manager looking at securities, doesn't matter whether it's shares or fixed income, you're going to be looking at a lot of different aspects when you evaluate that. It's not just whether or not they're green or sustainable. You're looking at the strategy, the leadership, the capital markets, etc. And let's face it, fund managers can and do get these calls wrong from time to time, just like non-ESG funds. And so we would say, as we were talking about before, you've got to look to understand, well, what does a good outcome look like? What does it look like in shares? What does it look like in fixed income? What does it look like in a specific type of strategy? What does it look like in a way that fund is implementing that strategy? And once you've got a good handle on, well, what is the fund actually trying to achieve, then you could look at it and say, well, is the outcome in terms of getting a better return, fit for purpose for that fund? Because obviously, if you're running some form of modified green index strategy, that's going to have a different implication of performance versus trying to be an impact fund. And we would say, well, what does outperformance even mean? Is it purely just on the financial returns to an investor? If it is an impact fund, but what about the non-necessarily financial aspects that impact fund is probably trying to deliver? I mean, how do you attribute that? And so I think, understanding whether or not outperformance versus the broader market is even what you're trying to achieve is important to understand. And whether or not it's using an ethical strategy or a sustainable strategy is also important to understand as well. Because if you were just looking at ethical funds, so for example, a lot of those shot the lights out last year because they were short energy and long tech, and tech was shooting the lights out. You look at year to date this year, and generally they've all gotten a huge bath, because the tech companies all crashed on the back of massive overvaluations or peak valuations that reverted, and energy stocks have gone bananas. I mean, is that a failure? Well, no, it's not. It's just where the exposures were, because that was how they set the parameters of those funds in what they wanted to look at. So we would say probably be less thinking about does it outperform the broader market, but understand that in some ways it's just like another source of return. And sometimes it will do better than the broader market, and sometimes it won't. It'll be cyclical. But if you think over the very long term, if a company is trying to be more sustainable, invariably that will flow through to its bottom line. And that's got to be good for enterprise value. But it's not necessarily just going to be a straight better or worse conversation, I think.
Thanks, Doug. So it's complex, we know that, and the returns drive off a range of decisions that investment managers make. Does that mean that it's going to cost more to invest in a responsible way or with an ESG base?
Yeah, sorry, that was part of the question I didn't answer. So that's another loaded question because, based on what? So obviously you have to compare like for like. You have to compare strategies in the same asset class and the same method of implementation. So, for example, you would have to compare a responsible investment fund in Aussie equities active managers on a like for like, or global index-based managers like for like. And we would say that generally you do see that there are funds that are perhaps slightly more expensive than their peers, but there are always exceptions to the rule. And I think this is why when you kind of look at averages, it can be misleading because, you can't necessarily invest in the average. You've really got to look at, are you happy to pay the fee for what it is that you're getting and take it from there? Because, at the end of the day, fees are one thing, but returns in your hand are the other. And yes, higher fees will lessen the chance that you might get better outcomes, but it depends on what you're trying to achieve. So, there's a lot of heated debate in academia around the world about is it cheaper or dearer, and is that the right thing for fund managers to be doing? There is absolutely no consensus on this. I think it's really a case-by-case basis.
Okay. Thanks, Doug. Wanted to move to some questions now, if I may. And I think perhaps the first one is a really broad one, but it's one that, is it just a fad? Is it just something this is going to go away, or is this something that's really important to the fundamentals of investing into the future? Liz or Doug, I'm very happy for either of you to answer that question, recognising that you're both heavily invested in your careers in this space.
That's not a loaded question at all. So, look, from Zenith's perspective, we would say, look, of course, we've had plenty of fads before, which I'm sure many of you on the call can remember. I mean, Australia's had the minerals boom in the late 60s and 70s. You had the dot-com boom in the 90s. You've had the BRICS. You've had the Asian tigers. They've all come and gone. So why is this different? And we would say, look, there's probably two things there. And what you've got is this intersection between a difference in societal views on the importance of sustainability, and you've got regulatory change. And so, look, for all that you could maybe argue that the societal views will change over time as to whether that's important. Look, personally, I don't think so, but you could certainly argue it. But unlike all the other fads that we've seen come and go, this is very heavily underpinned by regulatory change and around the world. And Australia, to a certain extent, is a little bit of a laggard on that. But I mean, we have had over 700 different pieces of global legislation on this in the last decade. And the pace at which that regulation is hitting markets around the world has just gone parabolic. And it's very time-consuming and costly and unwieldy to unwind regulatory change. And to be honest, I just don't see it happening. And I mean, as far as sustainability goes, like, it doesn't matter what sort of business you're in. People are going to increasingly ask you, like, whether it's your client market or whatever, how is your business trying to be sustainable for the long term? And I mean, what's the counter argument to that you're trying to run an unsustainable business? Like, this is just not going to work. So, yeah, we think it's here. It'll definitely change shape and form over time because that's just the way that things work. And there'll be periods where, things go really well, and there'll be periods where, implementation of this and the outcomes will be challenged. But I just don't really see it going back to the status quo. I don't think that is very likely at all, personally.
Thanks, Doug. Liz, do you want to add something to that?
Yeah, sure. So I was just going to say, for our part, our team has been, screening out issuers who have heightened ESG risks, in our funds, for over 20 years. It just wasn't called, ESG back in the day. So things like, Adani, Abbott Point, they were never, on our approved list because of the potential, environmental damage that they could cause. So ESG integration into the investment process, is not a recent fad for us. It's just really prudent risk management and, as I said before, avoiding those pitfalls that may crop up. In terms of the label bond market, I expect that it will be a part of our bond market for a number of years to come. But I do wonder whether we get to the point where good companies that have strong sustainable practices won't need to issue, green bonds. because the company as a whole has best practice, and if, investors might feel that they don't need to actually buy the label bond when they can just buy the more vanilla bond of that same company. So I think we may get to that point at some stage, but we're just not there yet.
Liz, can I also ask you, you mentioned earlier greenwashing and something you look for in your processes. And we saw ASIC recently come out with their priorities for the next 3 to 5 years. And they said they were going to be focusing on greenwashing as well. Can you explain what it is and why it matters?
Yeah, so we really scrutinise all the deals that come through. So we have a group of credit analysts that do a deep dive into the structure of these deals and look at the type of assets that are being ring fenced for green or for social purposes. As I mentioned earlier, things that we might look for are, is this business as usual for that company? So to give you a live example, NBN, they replaced all their copper cables with fibre optics. And this was, a lot more energy efficient for them. And they raised capital for this via a green bond on the back of it. We found that this was, a bit of a stretch because this was something that they were doing anyway. It was business as usual for them. But then they, took the advantage of then, issuing a green bond on the back of it. We did buy that issue just because we like NBN as an issuer themselves, but not because it was a green bond. So we would have bought it regardless of whether it was green or not, but we would have considered this, a bit of greenwashing. SLBs, they're the ones that have been sustainability linked bonds. They've been, under the spotlight a lot. And what we need to do there is really make sure that the targets they're putting in place are ambitious. So, we'll look at things like, if they've got a target in place, how does that compare to, their peers? What baseline year are they using? Are they in line with science-based targets, etc.? So they definitely have to go under a lot of scrutiny. And, we need to ensure that there is credibility for these deals and that they aren't being greenwashed.
I think maybe, Lee, to add to that, it's probably important to recognise that greenwashing definitions are almost as voluminous as ESG definitions. And I think, the simplest way to think about it and why you understand why it matters is to say, well, okay, if you're going to over-exaggerate your claims on issues relating to sustainability or a responsible investment strategy, the reason it matters is like, well, at best, as with any investment program, if a manager's being essentially, I suppose maybe not dishonest, but, gilding the lily around their claims on that, it's going to be very difficult for a client to trust in the outcomes. But at worst, obviously, over-exaggerating is going to be very damaging to confidence. But if you think about it on a company level, on an enterprise value level, if you essentially over-exaggerate what it is that you're doing, increasingly now you're running a massive risk of litigation. And this is what we're seeing just go vertical here and everywhere else in the world. And so that is obviously a huge landmine for enterprise value. I mean, you've got now well over 1,000 cases around the world of climate litigation happening. There's over 100 of them happening here in Australia right now. And, it's almost like every week you see a new one pop up. I think Santos was the latest one who's gotten hit with a greenwashing claim. And so, even if they win, that's going to cost them a packet, and that comes off enterprise value. And so I think, understanding what are the perils of greenwashing, I mean, regardless of what it might mean for, the efforts to be sustainable and how critical that is sort of for society as a whole, think about the damage to enterprise value when somebody does get hit with a greenwash litigation, because it's just going vertical.
Thanks, Doug. So when we were preparing for this chat and this seminar, I said, I reckon we'll get a question around decarbonisation and coal mines and so forth. And we haven't got one yet. So I'd encourage anyone who's got that question to ask it. But what we have got a comment on from someone is about, we let's say the science is settled, and I think most people would agree with that. I hope so, on the need to reduce carbon emissions, and how we do that is the debate rather than and how fast we can get there. But what other factors are there? We've got a question about, the risks of the hydrogen economy and whether, the replacing carbon with carbon emissions with, or carbon dioxide emissions with hydrogen emissions might create more problems. How do we assess these really tricky things when it comes to, you know, where the path, perhaps the science is settled around the need to reduce, but how we get there is not so clear yet. How do you bring those things into your considerations? You prepared to take that one on, Liz or Doug?
Yeah.
It's a big
Look,
one.
I think maybe while Liz sweats a few bullets over there, our way of looking at this, and without getting caught up with about, well, what a greenhouse gas is, it's not to say it's not a valid question, but it is. But I think you've got to recognise with all of this stuff, there are no silver bullets. There are only compromises. And when you're looking at sustainability issues in particular, if you think that there's only positives to be had without negative trade-offs, I think you're kidding yourself. And if managers are saying, hey, here's all the positives and not talking about the negatives, that's a problem. And like, let's take something as simple as electric vehicles, for example. So a company like Tesla, where, you know, we get a lot of fund managers who will say, well, you know, we're buying Tesla, and so this is us in our pursuit of, you know, sustainability and ethics. And, you know, I might say, well, look, okay, that's fine, but you know, how are you actually coming to grips with the fact that electric vehicles are big users of things like rare earths in their battery technology? Rare earths tend to have a absolutely horrible track record of exposure to human rights violations and modern slavery risks. And so how are you, you know, coming to terms with, well, where do you balance the pros and the cons? You can even get things, you know, similar sort of arguments with fossil fuels. People say, well, okay, we need to decarbonise and reduce reliance on fossil fuels. I absolutely wouldn't argue that for a second. But let's think about the cons. Let's think about the fact that the four main pillars of modern society are basically things like cement, steel, plastics, and ammonia, which is what fertiliser is made out of. So all of those rely on the fossil fuel industry. If you just stop fossil fuel overnight, how are you going to replace those critical industries with substitute products? And this is why I think, you know, a lot of people talk about this is a transition, and what does a just transition look like, and how do you balance all these pros and cons? And I think, look, if you're an investor, it's not to say that you shouldn't invest in Tesla or you need to be anti-fossil fuels, but just understand where the pros and cons are and understand how that fits with your preferences. Are you comfortable to try and pursue the pros while accepting the cons? And if you are, fine, but kind of do it from an informed decision, so at least you're comfortable with the decision that you've made.
Thanks, Doug. Liz, is there anything you wanted to add to that?
Yeah, I mean, I guess the only thing that I would probably add, and I guess it sort of ties in with the question that you were leading to there about the transition away from coal. And I think the debate is really around, you know, as an investor, you know, how do we participate in this transition? Do we just exclude, you know, the big polluters, for example, or do we engage with them and help them on their transition pathway and, you know, make suggestions for better practice, you know, et cetera? And the trends that we've seen so far, like in the US, for instance, they're big on the ESG funds in particular, are really big on engaging with these issuers and making positive impact that way. Whereas in Europe, it's quite different. You know, they really shy away from investing in any of the big polluters, and they negatively screen them out of their investable universe. So, you know, I think as a practitioner, you know, we haven't sort of landed on, you know, what's the right way to go. At the moment, we don't buy AGL and Origin, like I mentioned before, but we are, you know, very aware that they're going to be the solution really on reducing our carbon emissions here in Australia. So for us, you know, at this stage, we're open to engaging with and having active stewardship, you know, with this sector. And it may lead to investment, you know, down the track. They've all got net zero targets in place. So AGL, I think, is 2040, Origin is 2050. So they're all working towards net zero. We're not there yet on investing in them, but as they move, you know, along that journey, you know, we're happy to engage with them, and it may lead to investment in some point. And I think that's how practitioners such as myself, that's how we can get involved and make a difference. As for the technology around it, that's a different thing. That's out of my scope. But, you know, just as far as an investor goes, what can we do to, you know, help the transition pathway?
I think that's a good point because, you've got to remember that obviously, firstly, you can't just simply divest your way to a clean economy. It's not the way the world works. But the other way is like, if you're trying to pursue invest in a very sustainable portfolio, maybe you have to accept that sometimes a portfolio like that is going to have to start out looking dirty in order to get to clean because it's a transition. And so this is some of the problems that you can get with people doing things like carbon screens where they just say, oh, well, here's all these big emitters. Well, yeah, okay, that's true. But firstly, that's a backward-looking measure. You've kind of got to look at where they're going. And if you're willing to support that where they're going, maybe that fits in with your view of sustainable investing. Maybe it doesn't. Maybe you just say, no, that's it. I want to do a hard ethical screen. And that's also fine. But it comes back to what we're saying about, you've got to choose what's fitting the preferences for you and how you get there rather than just sort of hard labels on things.
Thanks, Doug, and thanks, Liz. So we're just a minute over time. I've got one more question popping up. Peter, snack that in. So we might take that question and then I'll wrap up. So we've got a question around, are there in the agricultural sector and whether there's opportunities for ESG investing in that space? I don't know who's best to take that one. Liz, is that something you on
as a former fifth generation farmer, maybe I'll take that one. It's a super interesting question. I mean, the ag sector is another one that's got a fairly big chunk of emissions bound up in there. But what we're actually starting to see is some really interesting stuff come out around things like regenerative farming, carbon storage, farmland remediation. It's a bit trickier to get it through, particularly in listed securities. Particularly here, there's a few more options overseas. In private markets, there's actually quite a bit going on there. But it's another one of these really hard to decarbonise sectors, if that's the lens that you're looking at it through. But, things like biodiversity, I mean, that's another one that the ag sector is very cognizant of the fact that that's a big consideration. I mean, the other one is food. I mean, let's face it, the food's got to come from somewhere. With population growth where it is, everybody has to work harder and faster on this. So I think, like everything, opportunities will come and go. It's going to be very dependent on the different types of funds out there and how they're implementing their investment strategies as to whether or not those opportunities make sense. But yeah, look, in short, absolutely, there's going to be opportunities.
Okay.
Yeah, I just, I don't have a lot to add there, but I would just say that we haven't actually seen those opportunities come through in the fixed income universe. I think equity is probably where those opportunities will arise, but we haven't seen any bonds that are specifically, related to improvements in the agricultural sector.
Thanks, Liz. Yeah, we've seen a couple of things come through with that technology and on that equity side, but yeah, that's interesting, isn't it? Okay, well, look, I will bring this to a close. Thank you, Liz. Thank you, Doug, very much for your contributions today. It's a really nuanced topic, and I think we've done it some justice. I think we've drawn out some of the issues, and I hope everyone on the call has learned a little bit. I certainly have. So thanks again for joining us today, and I'd say in a little virtual clap for our panelists. Thank you very much. Thanks for joining us. And there will be a video available for this session in a day or so once we package it up. If you'd like to share it or you weren't able to join us today, we'll send a video out to our client base. So thanks again. Thank you all, and have a great day.